Hello everyone, this is Rich Parsons, CMT. Let's talk about what's been going on the last couple of weeks here. We've seen the Brexit. We've also seen, however, a report by ISM, their report on business in relation to their manufacturing indicators, of which they ran a survey of what business in the UK is considering. And it doesn't sound like they're all that worried of the future in terms of Brexit. Now, on Friday, we heard of the June U.S. PMI, and we also learned from Market Economics and Cakeson that the China PMI was slipping yet again, and I think it was like a 4 to 5 month low. It's still below 50. They're still having a sluggish time. The JP Morgan Global Index, still very sluggish. Global economy is not responding the way it should have relative to various business cycles from 3 years up to 9 years. But it did show some evidence that the Eurozone was improving, or Europe in general was improving. Although I'm sure some are concerned, what will Brexit do? Will it interfere? Now, the Vietnam PMI was one of the few in Asia that actually looked like still strong growth for new orders and picking up, and low inflation in terms of their input costs for manufacturing. Now, the US PMI, which I'm showing you here, was just recently updated for June. And you can see it had a nice little surge up, got up into the 53 area. Looks like it survived a brief correction. So it looks like the forecast made some time ago for a long-term 3-year cycle bottom is correct, and the trend is higher into late this year and more likely on into next year for a top of manufacturing. Now, when this indicator is above 50, it is assumed the economy is growing. So it's not just manufacturing. People view it as an indication of the economy. Now, when it's below 50, you have contraction. And my personal opinion is that when it's below 45, and I might even prefer 43, the economy is in recession, but I prefer it to occur in line with a 9-year cycle. So if it's a 3-year cycle by itself, I'm going to assume it's probably just a fluke, that it's a flash in the pan and the economy will recover quickly. If it's still larger cycles than 9 years, however, I'm going to be concerned of chance for depression. Well, back in 2008 to 2009, we had several different indicators in the stock markets bottoming, specifically for the U.S., for super cycles. So the chance of a super cycle bottom occurring in the next few years is about 0, okay? So I rank it as a 1% probability we're going to have some kind of blowout crash in the stock market. I think when the next recession occurs later this decade, we may only see a 20 to 30% correction in the stock market, and that will be a gross overreaction to the economy, which may not correct much of all. We may have one of the mildest recessions we've seen, and it's just because it's been a struggle for the entire world to get going out of this super cycle low a few years ago and put an end to what really is a depression. It's just we clouded it, mask it with various incentives and stimulus, okay? So next decade, the economy should be even better, and the markets will be even better, stocks and commodities. But right today, we still have a few complications and problems to work out. And so my forecast is economy grows into 2017. It may pull back and then grow on into 2019. And so the recession can delay to 20 to 2021, which 2021 is probably the latest year for a bottom of the recession. And how this works is a 9-year cycle, which you can see back here in the early 2000s for a recession. There's the cycle coming into the collapse, but far more severe because of super cycles as well. But the 9-year cycle basically relates to 7 to 12 years of economic growth and 1 to 3 years of economic contraction, if not recession. Combine those two trends, you get a cycle every 8 to 13 years, bottom to bottom, top to top. And another way of putting it is you get a recession every 8 to 13 years. Now, you can have recessions more often, but how I view them is they're normally secondary. And occasionally you do get 2 primary within 1 decade, which is just what recently occurred. And I think that reduces the odds of any serious problems this decade. So at any rate, the manufacturing indicator is doing quite well here. So I have my fingers crossed that it's finally turning higher. Now I'd like to see the global PMI pick up as well, and a few other nations in Europe to pick up. And now, of course, we have to deal with Brexit. Now, what does this have to do with the stock market? Well, the stock market looks like it's poised to move higher into next year. the question is there more range trade, more pullbacks, consolidation to occur, say into fall, and then higher? Or has the market already started? It seems to be relieved that it's figured out Brexit and is not too worried about it. Some people say it could take 10 years for the UK to truly be out of Europe. And the point is, they're still going to want to do business in Europe. Okay. Others say, however, it'll take about 2 years. Well, that's long enough for the stock market to rally and long enough to delay any complications, but I'm sure people will be looking over their shoulder, worrying what might go wrong along the way. Okay, now, what I also want to point out is that if the stock market marches higher to a record high now, fine, it's probably going to remain in a bullish posture right into next year. But there's a slight chance for an intermediate cycle in the next couple of weeks, something like that, that can put it back down. And it looks like that with the recent jump up, that maybe the market would have made a mistake and we're going to have a lengthier down. And so there's still this risk of at least some consolidation, maybe sideways range, some choppiness for a few months. So how I view it is, if you're feeling bullish, be bullish. But the low of June for something like the Dow Jones Industrial Index or the Diamond ETF that people trade, DIA, watch that low, that risk point. And this should be the same for S&P 500. The risk point would tell you then there's something wrong. It may have to consolidate lengthier. Now that is if the market turns down in the next month. If the market stays up for 2 or 3 months, we may have a different picture if it should come all the way back down to that June low, and I'll reevaluate and try to update. At any rate, it's looking like long-term still positive for the bulls. Maybe a struggle, maybe a glorious bullish move that we finally get the global economy going. But I think you got to view the June low as a risk point, and I still question, is it time for the stock market to march forward? This next chart is the GDP, gross domestic product. It's put out by the Fed system, that's St. Louis Federal Reserve. That's the system that actually charts this. And you can see for the 1950, here's the gross domestic product, and look at this. You get a nice slam here, the biggest correction since the 1950s of gross domestic product. Well, as it turns out, a super cycle low of 72 years was due just about that time, so it was a correct call by the cycle. And then it was supposed to be the second most important cycle since the 1930s, so one would think you would get the second most important pullback and also various bear markets for that. And if you look around the world, we certainly got some serious bear markets. Some countries were down 90%. In this country, some real estate was down 90%, and that's the definition of a 72-year cycle, is about 70-90% corrections in a lot of markets. But as it turned out, our market wasn't that severe, and I correctly forecast ahead of time we were going to do something to put the brakes on. We were going to manage it better than other countries, and I decided the stock market would only drop maybe 40 to 60% relative to the next smaller cycle, a 36-year cycle, and the stock market dropped about 50%. So it worked, but you can see, at least for the gross domestic product, the 72-year cycle created the most significant correction, at least from this chart, since 1950. My stance is it was the largest correction and impact from a bearish cycle since the 1930s. I'm Rich Posson. Thank you.